My name is Sana Babar. I am a junior at Texas Southern University. This is Finance 301, Section 01. This is my DuPont analysis project and report for Spark Energy Incorporation. So what we're going to see is this is a research report that will evaluate the current financial performance of Spark Energy, and which is a publicly traded company using the DuPont chart analysis. This will be done by carrying out a time series and cross-sectional analysis with Genie Energy Incorporation by using the 5 classes of financial ratios. So we have efficiency, liquidity, leverage, profitability, and market. This research analysis report will be used to show how well or how poor Spark Energy is doing against its competitor, Genie Energy. And this report will give us an insight about into the future growth or decline of Spark Energy. So in order to evaluate this company, we must first analyze Spark Energy's financial statements, then analyze the supporting financial ratios in which we calculate to show and clarify Spark Energy's financial position. And this is where we would compare Spark Energy and its competitor, Genie Energy, to see if the company is a good investor. So this over here is my Excel sheet. And as you can see, this is its financial statement for Spark Energy. And then we have the ratios, all 5 ratios between Spark Energy and Genie Energy. And we will look at that later on in this presentation. So, the introduction, the oil and gas electric industry is an ever-increasing industry with more and more innovation, with companies trying to get a slice of the profit from an always needed and expanding resource. Spark Energy is an electric and natural gas retail provider in which they provide competitive pricing to set itself apart from its competitors, which was established in 2007. So, and started in Houston, Texas, the largest energy capital in the world. Spark Energy has approximately 400 employees across the United States and over 16 U.S. states. So that's a little bit more about Spark Energy. And what we're going to see is a ratio analysis between Spark Energy and Genie Energy, which we will analyze later in the presentation. So this is a time series cross-sectional analysis. So we'll go through the liquidity ratios, efficiency ratios, leverage ratios, profitable ratios, market value ratios. And you can see that we are comparing Spark Energy and Genie Energy within all 5 of those ratios. So in the liquidity ratio, a company's ability to pay off their current liabilities is known as a liquidity. Liquidity ratios show how much cash and assets can be converted to cash in order to settle the company's outstanding debt. When examining the liquidity ratio for Spark Energy, its current and quick ratio was analyzed. The current ratio formula is the current assets divided by the current liabilities. If the result is greater than 1, it would mean that the company does have enough current assets and are able to pay off obligations or are able to settle its current liabilities. However, if it's under 1, it would mean that the company would not be able to pay off its obligations, in the case a company files for bankruptcy. So, the current ratio for Spark Energy from 2014 to 2018 is 1.14, 1.21, 1.08, 1.96, and 2.06. So in this one, we can see the ratios. Oops. So we're looking at this right here. So Spark is 2.6, 1.96, 1.08, 1.21, and 1.14. And when we can compare that to the current ratio for Genie Energy, which is 1.93, 1.65, 2.38, 3.05, 4.44. Alright. Spark Energy's overall current ratio continuously goes up, which means the company has enough cash and assets that can be converted into cash in order to cover its current liabilities within the company's operations. We can see that the company has no issues creating their non-cash assets into cash, which can also mean that the company would have no issues paying their liabilities as well. So in this one, we can see that Spark Energy is doing fairly well. So it goes from 2014 to 2018, and it's increasing at a steady rate. Meanwhile, Genie Energy is slowly decreasing. So it went from 4.44 all the way to 1.93. Genie Energy, a competitor to Spark Energy, has a current ratio of 4.44, 3.05, 2.38, 1.65, 1.19, or 1.13 from 2014 to 2018. As we can see, Genie Energy's current ratio started off relatively high, but as the years passed, their current ratio significantly decreased. And we can see that here. So between this and here. So between both of them, Spark Energy has been increasing, meanwhile Genie Energy has been decreasing over the past 4 years. This could mean that they have either sold off many of their assets or borrowed more from investors. Spark Energy seems to be doing better in this aspect because it has a trend of increasing within the past 5 years. Meanwhile, Genie Energy has not. Overall, both companies seem to have no difficulties converting their assets into cash if they needed to pay off their obligations, which is a good thing. So now we will be looking at the quick ratio measures a company's ability to pay off its current liabilities by using assets that are most liquid. A company with a decreasing quick ratio suggests that the company has taken on too much debt and is struggling to maintain or even grow their revenue and is collecting their receivables at a very slow rate. On the other hand, a company with a high quick ratio means they have less debts and are maintaining or increasing their revenue to collect their account and receivables at a faster rate. Spark Energy's quick ratios from 2014 to 2018 was 1.06, 1.16, 1.06, and 2.03, which means that the company has enough quick assets to maintain its short-term debts as it's been increasing over the past 5 years. Genie Energy's quick ratio from 2014 to 2018 is 4.09, 2.75, 2.323, 1.157, or 1.57, 1.73. Genie Energy has enough quick assets to maintain its short-term debts, but the company has been on a decreasing trend up until 2018. Spark Energy seems to be doing better than Genie Energy. So when we're looking at the quick ratio here, we can see from 2014 to 2018. So we can see from 1.06 for Spark Energy, it's from 1.06 to 2.03. they have been increasing, really fluctuating, but mostly they were slowly increasing. Meanwhile, Genie Energy, they have been decreasing. So it's been from 4.09 down to 1.73. So efficiency ratio. So efficiency ratio measures how a firm can effectively use its available assets to generate more revenue at a faster rate. The three ratios will examine the inventory turnover, average collection period, and total asset turnover. For inventory turnover, the higher the ratio, the better for the company because it measures how fast a company is selling its inventory. Spark Energy's inventory ratio for 2014 to 2018 is 41.87, 41.24, 93.01, 134.31, 202.56, while Genie Energy's inventory turnover from 2014 to 2018 is 30.75, 12.48, 15.51, 35.83, and 29.36. It's clear to see that Spark Energy has much higher inventory turnover compared to Genie Energy, which also has been increasing the rate for the past 5 years. Sorry. We can see that Spark Energy has a much higher inventory turnover compared to its competitors, and it also has been increasing over the past 5 years, when Genie Energy has only been fluctuating within their numbers over the years. So we can see here the inventory turnover over here. So Spark Energy is 41.87 to 202.56, which is a massive increase over the years. Meanwhile, when we're looking at Genie Energy, it has been decreasing, or not even decreasing, it has been fluctuating. So it goes up and down. So 30.75 to 29.36, but in between you see that it goes decreasing, then increasing, and then increasing even more, and then it starts decreasing. When we measure the company's average collection period, we typically look for the smallest ratio, as it shows us an approximate amount of days the company takes to collect its receivables. For Spark Energy's average collection period for 2014 to 2018 is 71.49, 63.05, 57.56, 62.04, and 56.18. Meanwhile, Genie Energy's average collection period from 2014 to 2018 is 70.19, 74.59, 86.85, 87.12, and 75.83. So what we see is that Spark Energy seems to show a steady decrease in their collection period, which means that they've been collecting their receivables at a faster rate over the years. And Genie Energy seems as if its collection period has been fluctuating throughout the year, but their overall is still higher than Spark Energy's collection period. This shows that the Spark Energy receives money from its receivables at a faster rate than its competitors. The total asset turnover shows the efficiency of a firm based on how they use their assets to generate more revenue. For the company, the higher this is, the better. The higher this is, the better. So Spark Energy's asset turnover from 2014 to 2018, and we can look this up. So asset turnover. its total asset turnover is right here. So we can see from 2014 to 2018, for Spark Energy it goes 2.61, 2.38, 2.03, 1.81, and 2.08. So it is fluctuating. And for Genie Energy, it goes from 1.76, 1.36, 1.53, 2.13, and 2.06. So Genie Energy has been increasing. Meanwhile, Spark Energy has been fluctuating around. So it decreases from 2014 to 2015. It decreases from 2015 to 2016. It decreases from 2016 to 2017. But then it also increases as well. So in the end, it increases. So now we're going to talk about leverage ratios. So we will see the difference between our leverage ratios between Spark Energy and Genie Energy, and we can determine who's better in that. So when calculating leverage ratios, we are trying to look at how much financial leverage a company has over its debts. We will look at two ratios, the debt ratio and the times leverage, and the times earned interest ratio. When measuring debt ratio, the lower the ratio, the better it is for the company, as we're trying to have more assets than liabilities. Spark Energy's debt ratio from 2014 to 2018 is 0.83, 0.7679, 0.67, 0.60, 0.63. When meanwhile Genie Energy's debt ratio is from 2014 to 2018 is 0.22, 0.26, 0.34, 0.47, and 0.37. Spark Energy's debt ratio has been decreasing over the years, when meanwhile Genie Energy's has been increasing. So both of these companies have a solid debt ratio, but Genie has lower ratios in general over the past years, making it better overall. And we can see here as well, debt ratio. So for Spark Energy, it's 0.83 all the way down to 0.63. So it has been decreasing, and Genie Energy has been increasing or really fluctuating. So it goes from 0.22 all the way to 0.37. When we're talking about times earned interest, we're trying to calculate how well a company can make its interest payments. A high interest ratio means the company is able to make its payments, meanwhile a low rate means that a company is having a hard time paying its interest. So we can look at the Spark Energy's time earned rate interest ratio from 2014 to 2018. So let's go. So we can see that Spark Energy from negative 3.27, which is in 2014, 2015, 12.26, 8.59, 10.22, and negative 1.31. When comparing Spark Energy to Genie Energy, the first 3 years is not available, but the last two years, so 2017 and 2018, it shows that it goes from negative 22.33 to 22.50. So it goes from a negative all the way to a positive. So we can see many fluctuations within the income and the abilities to pay off their interest. So this is for Spark Energies. They do have a bit of um, fluctuations within their their time interest earned ratio. Meanwhile, when you look at Genie Energies, we can see that from 2014 to 2018, 2016 that they had no interest incurred, and later from 2017 to 2018 it shows a massive increase. So from negative to a positive. We see that the company did not acquire interest until 2017 and went from an extremely low interest ratio to an extremely high interest ratio within a short span of time. We can see here that Genie Energy is doing better compared to Spark Energy, which is really good. Profitability ratio pinpoints how well it's doing in their specific market. These ratios will determine how well a company can generate more earnings compared to its expenses and other costs that the company may obtain. Some of the ratios we use to evaluate Spark Energy's profitability and total profit margin. Some of the ratios we use to evaluate Spark Energy's profitability are total profit margin, net profit margin, return on assets, and return on equity. When we measure total profit margin, we look at how much revenue a company has past its costs. From 2014 to 2018, the total profit margin from Spark Energy was 19.90, 32.66, 36.90, 30.81, 15, and 15.95. This shows that Spark Energy had a major downturn in its profit margin in the past 2 years. With Genie Energy, its total profit margin from 2014 to 2018 is 18.88, 32.88, 36.27, 32.37, and 27.31. Genie Energy's profit margin seems to be fluctuating over the years, but in 2018 its margin has declined. Genie Energy still seems to be doing better, as the loss wasn't as significant as Spark Energy. Next, we measure the net profit margin, which measures the percent of income received from sales. For Spark Energy between 2014 to 2018, the net profit margin is as follows: negative 1%, 7%, 12%, 10%, and negative 1%. Spark Energy's net profit margin has fluctuated over the years, but in 2018, the profit margin drastically decreased, causing the net profit margin to be non-existent. With Genie Energies, its net profit margin from 2014 to 2018 is negative 10%, negative 4%, negative 15%, negative 3%, and 8%. We can see that over the years, Genie Energy struggled to make the net profit, but in 2018, it managed to create a drastic increase to generate profit for the year. Genie Energy seems to be doing better than Spark Energy in regard to the 2018 year. When we analyze for the return on assets, we are looking to see how well the company creates profit compared to its assets the company has. When measuring the ROA, the higher the better. For Spark Energy, the ROA is negative 4% to negative 3%. We can see here that the company was making great progress in ROA until 2018, in which we see a major downturn in their percent. When we measure the ROA for Genie Energy, we can see the percentages are as follows: negative 19% all the way to 9%. Almost every year, Genie Energy has struggled with the ROA going negative up until 2018. Throughout the years, Spark Energy would be out and Genie Energy, but in the most recent year, Genie Energy seems to have the advantage. Lastly, when we measure the return on equity, we're looking to see the amount of return stockholders receive back from their investments. The higher the percentage, the better. It shows that the company produces high return for investors. For Spark Energy, the ROE from 2014 to 2018 is negative 18% to negative 16%. We can see that Spark Energy has a fairly high rate of returns between 2015 to 2014, and in the recent years, a fairly high rate of returns between 2015 to 2017, which is 78%, 53%, and 47%, which in the recent years, the ROE has declined. When we measure Genie Energy, we can see that the ROE from 2014 to 2018 is negative 23 all the way to 23%. Judging from the most recent year, the best company to invest in is Genie Energy, but if we're judging from the past 5 years, the safer company would be Spark Energy. Now market value ratios. When we're going in depth about price earnings, we are looking at what investors are willing to pay for a share within. When we go into depth about pricing earnings, we are looking at what investors are willing to pay for a share within a company. When measuring this, we are looking for the higher ratio, as that means investors are more confident in investing in that company. For Spark Energy, the pricing earnings for 2014 to 2018 is negative 6.21, 13.52, 10.37, 9.38, and negative 10.77. Spark Energy started from extremely low ratio due to a very low net rate earnings per share, as seen in the income statement. However, the PE managed to pick up significantly in the next 3 years up until 2018, when it hit a downward slope. For Genie Energy, the PE for 2014 and 2018 to 2018 is shown as negative 4.08, negative 24.48, negative 4.54, negative 11.44, and 7.01. For dividend payout, we are calculating the profits and which dividends are paid to its shareholders. The higher ratio means that there's higher dividend payout to its shareholders, which also means that the investors are more likely to invest if a company has a higher dividend payout ratio. For Spark Energy, the dividend payout between 2014 to 2018 is not available for 2014, but 2015 it is 0.27, 2016 is 0.10, 2017 0.10, and 2018 is 0.49. And for Genie Energy, from 2014 to 2018 is negative 0.05, negative 0.30, negative 0.11, negative 0.83, and 0.835. For the Spark Energy, the dividend payout had a dip throughout its year, but rose back up in 2018. But with Genie Energy, it seems as if the company only recently started to generate enough capital to pay its shareholders from the earnings of the company itself in 2018. Out of these companies, Spark Energy is the company in which investors would invest in terms of receiving money back from the dividends. Next, we will be evaluating the market to book value of a company, which tells us of if a company's shares are overvalued or undervalued. For Spark Energy, the market to book value from 2014 to 2018 is shown negative 1.42 to 1.43, and Genie Energy's market to book value from 2014 to 2018 is 1.12 all the way to 1.75. Both of the companies are over 1, which is good from an investor side, although Spark Energy in its previous years did have some downfalls. It did significantly decrease after a huge rise in 2016. For this reason, Genie Energy has the better market to book value. In conclusion, after reviewing the different types of ratios for Spark Energy and comparing them to Genie Energy, it's clear to see that Spark Energy has seen its ups and downturns in the past 5 years. For Spark Energy, its liquidity seems to be fairly decent, as it shows that the company doesn't seem to have any issue paying off its liabilities. In terms of the efficiency ratio, Spark Energy collects its receivables at a much faster rate than its competitor, while having a fairly high inventory turnover rate from year to year compared to Genie Energy. As far as a profitability and market ratios, it seems as though Spark Energy has had a profitable downturn in the past year, which is 2018, in which the trend is seen in almost every ratio calculated. The company is still viable to invest in comparison to its competitor Genie Energy, but investors will have to watch the stock and profitability of the company closely in the next upcoming years.